Welcome to Private Equity Profits. Clifford Locks is a certified board of director, a trusted confidant to CEOs, C-level exec, and high-potential employees to help them clarify goals, unlock their potential, and create actionable strategic plans. Seth Greene is the nation's foremost authority on growing your portfolio companies with direct response marketing. He is the founder of the direct response marketing firm Market Domination LLC, and he is an 8-time best-selling author who has been interviewed on NBC, CBS, Forbes Inc., CBS Money Watch, and many more. Cliff and Seth interview top players in the financial sector, focusing on private equity firms, venture capital companies, and family offices, discussing developments and trends shaping the industry. These experts will share with you how they've grown their businesses and increased profit, and how you can too. And now, here's your host, Cliff Locks.
Welcome, everybody, to another episode of the Private Equity Profits Podcast. I'm Cliff Locks, your host. Today, we have our guest, Jon Siegel, co-founder and chief investment officer of RailField Partners. RailField Partners is an experienced investor that focuses on high-quality multifamily assets while seeking to minimize risk, generate above-market returns for investors, and create a sense of community for the residents. Jon has also served as the director of acquisitions from NHP Incorporated, the largest owner and manager of multifamily real estate in the nation, where he is responsible for transactions involving the purchase of real estate, partnerships, interests, and operating companies. He has over 25 years of experience in multifamily industry and expertise in strategy, acquisitions, and financing. Jon, thanks for being on the show today.
Hey, thanks for having me. Really appreciate it.
Same here. Tell me about your background and how you got started on the journey that brought you to where you are today.
Well, I sort of fell into real estate. I started working when I got out of business school for NHP, which was, as you said, the largest owner of apartments in the country. Yeah, that was a great experience for somebody who didn't really know what he was doing in his 20s, and they let me have a lot more responsibility than I probably should have had. And so that was a great experience when you're the acquisitions guy until they decide to sell the company. And so then they don't usually need the acquisitions guy when they sell the company. So that facilitated my transition to becoming a lender. So I had been on the principal side of investing in the multifamily space. I ended up going to Fannie Mae, where I was on the side. So I sort of sat on both sides of the table. And I actually, as a guy that always fancied himself to be sort of entrepreneurial, ended up working for the two largest companies in the industry that I'm in. So I worked for the largest owner, and then I went to work for the largest lender. So I guess that's good experience. Yeah. Always had sort of that entrepreneurial itch. And when I worked at Fannie, I actually had started buying, some small multifamily, little stuff, even single family rentals, a couple of properties on the side, sort of scratched the itch a little bit. And it sort of became the worst kept secret at Fannie Mae that I was doing this on the side. And my colleagues at Fannie, who's now one of my partners, Todd Watkins, came up to me one day and said, "Hey, I heard about what you're doing. I'd like to do the same." And so we started talking about it, collaborating a little bit, and working for a big company was getting to the point of, I think I'd reached my limit on the big company, as he had also. And we, one day after some horrible meeting at Fannie Mae, decided it was time to jump off the pier and go out on our own and try to make this real estate thing happen. So we left Fannie, and our timing was not opportune. It was around the great financial crisis, so pretty hard to start a new real estate company during the great financial crisis. But we persevered. We actually bought a company that was sort of real estate adjacent, and we ended up, everybody we knew came to us and said, "Hey, would you guys, want to do some advisory work?" So, we made lemonade out of lemons, and a company that basically ended up doing a ton of advisory work with the eye of doing real estate investing. Fortuitously, after, a couple of years, and when things sort of stabilized, the guy that we worked for at Fannie Mae, who ran multifamily there, a guy by the name of Ken Bacon, he decided that it was time for him to leave Fannie. And he reached out to us and said, "Hey, I have an opportunity. Would you guys be interested in doing this real estate investing thing you guys were talking about?" And we're like, "Of course, that's what we're trying to do." Sort of the genesis of RailField. And we were fortunate enough to, as I say, start on third base with some institutional money, which a lot of people don't have access to when they start an investment company. And that was 8 years ago now. And so it's been a pretty good journey since then.
That's an amazing career. You're on both sides on the table. It's just amazing.
Yeah, we like to say that we can sort of have a little bit of a competitive advantage because we sort of sat on both sides of the table. So we know where the bodies are buried, or however you want to say that. whatever the right.
You know how to get deals financed.
Yeah, exactly.
And you understand the due diligence extremely well. And you understand, when things could go a little sour, and how to clean things up.
Yeah. I like to always say to the young guys that work here now that now that I'm old, I've seen this movie before. When we talk about it, I was like, I think I've seen this movie before.
Very, very good. What are the basics regarding investing? What do you see as the foundation of sound investments?
You look at investing, you say, okay, the idea when you make an investment is to make money, right? I mean, at its most basic core, you're trying to find a way to make money. And, when I think about real estate, specifically what I do all the time, you're trying to find a way to generate either income or capital appreciation.
Mm-hmm.
But, so that's the foundation of it. And it's a question of how do you do that? And to me, it's really, and maybe this is where the reformed lender in me is, the real foundation is probably is assessing your risk and adequately addressing the risk that you have, because it's pretty easy to, it's easy to buy stock. It's relatively easy to buy a piece of real estate. Not as easy these days, but it's relatively easy, but it's not easy to do it in the right way where you minimize your risk, because, that's how people lose money. And so, when we look at an investment here, we look at a return and we always say, okay, the return is, say, we're looking for a 12% return. Okay. So on that 12% return, we want half of that return to come out of cash flow if we can, because when it comes out of cash flow versus just being able to turn around and flip a property and make an easy return, we say, okay, if half of it comes out of cash flow, well, then I've covered my backside because I have money coming in. And if my strategy that I have, because you go into an investment with a strategy, well, if that strategy doesn't work, well, then I have a way to keep going. I have cash flow coming in. I have legs. I have staying power. And eventually, time generally heals all wounds on these things. And eventually my strategy will come out. So that's a long way of saying, I think, really at the foundation is, finding out what your risk is, addressing your risks, and structuring your investment appropriately so that you don't get burned.
You're conservative then.
Yeah, we have to be appropriately aggressive in what we do. But yeah, we're
right. But you have the other side on the cash flow is everything at this point.
Yeah, and it's hard to do these days. It's harder to do. Stick to your knitting. But yeah, I mean, I think, the long race, again, that's the gray hair that you can kind of see here.
Very good.
My filters on my Zoom are maybe, don't show as much. But, a lot of people, when they go into an investment in our business, say, okay, I'm going to buy this thing and I'm going to put a bunch of money in, or I'm going to put a property and I'm going to flip it out in 2 years and I'm going to make a huge profit. That works sometimes, and we've done that. And, we always hope to do that. But if you go into every investment with that, expecting that to happen, you're going to get burned on some. So, we try to do no harm as much as we try.
Very, very good. Yeah, because we're in some interesting period of time, and the goal is to listen to your insights, during the interview, where you've got your finger on the pulse. You got an infusion of money coming in from overseas that needs to get put to work.
Yeah.
Assets are inflated.
Yes.
You could tell me if it's 25%, you have a better look at it. Interesting times.
Yeah. Yeah. I mean, I like to say now that when we started our business, when
8 years,
8 years ago,
mm-hmm.
we had some money. We had money from a pension fund, and we thought, hey, this would be super easy. We'll get money from a pension fund. We'll invest that money, and then we'll just go get some more money from another pension fund. But turns out that pension funds really aren't that excited about investing in money with three guys that have a couple of deals and have been in business. Right. So we had to sort of change our strategy along the way. And so we ended up, hooking up with some family offices and changing our footprint some and changing our strategy a little bit, which is normal things I think that happen to young companies. But I like to say back then, we had a lot of deals. Like we had pretty good deal flow. We were always seeing, but we just didn't have money. It was hard for us to find money. And now, as we've evolved and we've gotten deals done, we found money, we got deals done. And now we're back to having institutional money. Now I like to say, we got plenty of money and it's hard to find deals.
Excellent.
Because right now, the way the world is right now is everything is expensive, everything inflated, and everything requires, taking a huge leap of faith. So, it's an interesting place to be right now.
Right. I appreciate the breath of fresh air of just being very open with our listeners and their understanding that, this is where we are at this point.
Yeah.
Over time, it'll change. The pendulum swings back.
Of course. Yes. Yeah. I mean, over the long term, I think, it always does. And it's not like there's no opportunities. We're doing now. We have a deal that's closing on Tuesday.
Excellent.
Another one we just put under letter of intent.
Excellent.
We're still doing business, but I think we have to be careful.
I appreciate that.
Guys around here all the time. We don't want to be the last one at the party.
That leads me to my next question. What are the challenges and pitfalls associated with investing in real estate, and how do you overcome them?
Well, I think, in this day and age, the biggest, the challenge is obviously gauging where we are in the market and where we sit, in terms of pricing and growth. Because, when we went into the pandemic, it was interesting. That March, I guess 2 years ago, on that, March 15th or whatever day that was, everything ended. It seemed like, we had one of our investors called and said, man, we'll be lucky to collect 50% of the rent next month. And we, nobody knew what was going to happen. And everybody thought, oh my God, nobody's going to pay the rent. Every property is going to default, all that. It turned out that after a month of sort of uncertainty and everything, that in our business, everything went crazy, really. I mean, rent growth has been insane. Seeing 20% rent growth, where, we normally project 3% rent growth. We're seeing 20% rent growth. We're seeing cap rates have fallen 100 basis points. And so values have gone up by 25, 30%. So, at this point, it's sort of the question is, where are we and how do you make a deal work? Because what's happening now also is that we're seeing interest rates go up. So, so all the values, the rents went up, the pricing went up. You can sort of justify that when you can borrow money at, we closed the deal last year. We borrowed money, a 10-year loan at 2.75 or something, it was super low rates, but now rates are up, they're over 4%. Business, like you're buying a property at maybe like a 3.25% cap rate and you're financing it at a 4% loan. That doesn't make sense. That's upside down. So how do you do that? How do you function in this market? That's the biggest challenge right now is how do you know where to be appropriately aggressive? How do you know that, okay, to go from that 3.5 cap rate and a 4% financing to get my return to the right place, I have to assume that rent's going to go up 20%. Well, how do I do that? And where am I comfortable doing that and picking my spot? So that's really the toughest thing right now is knowing, where we sit and where do I be aggressive and, where am I not going to do something that 18 months from now I'm going to be like, what was I thinking? That's what I'm trying to avoid.
Look, sometimes the best deals don't get done.
Yeah. Yes. And we,
and I want a seasoned team. They understand that.
Yeah. No, we like I say, we're pretty good at banging our head against the wall and looking at
saying, look, this is not going to work. Let's just sit on the sideline, let somebody else pick it up. They're going to get hurt, but you're just a brilliant organization with a lot of the other side of, you understand the other side, and how the deals get funded and the numbers have to work. Okay.
Yeah. And people have money to put out and we have money to put out. And so you have, again, it's sort of that thing you learn in business called dollar cost averaging. You should always be in the market. You don't want to be the one person miss the time because you won't know that it got to a good point if you're not in the market at the time. So we try to always be in the market and always trying to make deals work and always trying to be appropriately aggressive, but also trying to make sure we don't make a mistake. So far so good. We haven't made one yet, but we'll probably do.
Think about that rent roll up 20%. In other words, think about that. That's tremendous.
Yeah, no, I mean, it just, as I said, we thought we wouldn't collect any rent. We thought we'd be lucky to, scrape by through the year. And all of a sudden rents are going up. Occupancy is at, 98% and properties are at 90%. Yeah, it's the term they're saying in the multifamily world is it's the golden age of multifamily. And it is, if you own the property and you're not looking to buy anything, you're banking pretty good money right now.
Very, very good.
It's a good market. And they can't build properties fast enough. It's great. But if you're in the investment world, you're paying for that. And so that's the.
Are you doing any development?
We don't do development. We don't really feel like we have that core competency. So we've just pretty much stuck with doing acquisitions. When we acquire property, we will do some rehab. Right. We will do sort of lighter stuff, but we don't have that. We don't feel like we have the core competency of development. We've been in the world for a long time and just, we know we're good at, sort of comfortable with that.
That's interesting. The rehab, are you finding that you're putting in quality materials and upgrades that really allows people to really flourish in their unit, meaning they're really happy?
Yes.
And the word of mouth. And
yeah, I mean, it's a good way, and it's what we call, value adds. So we're spending money and we're upgrading a unit, say, and we're getting a good return on it. The two issues that we have on that, which are one is just a real issue, which is the supply chain. We always hear about that.
Mm-hmm.
The excuse for everything now, the supply chain. So it's to get materials and they cost a lot more. The second thing is probably a good problem to have, which is that we tend to look at those things and say, okay, if we're going to spend money on a unit, we're going to spend money. We want we want a return on it. We want like a 20% return in terms of the rent we're going to get on it. And sometimes, right now the rents are going up so fast that you can sort of not spend the money and get close to the same returns. Or like, why spend the money if you don't have to? And, and that's a fine line that we run also, because we take a lot of pride in the properties we own. So we have to make some decisions there sometimes.
Very good. Are there any recession-resistant assets? And if so, what are they?
We like to say in the multifamily world that multifamily is the recession-resistant asset class in real estate because the rents are repriced. You can functionally, a hotel, I guess you can say, is the ultimate one, except that nobody travels and nobody's staying there. But you can reprice the rents every day. In multifamily, everybody needs a place to live, so there's always demand for multifamily, and we can reprice the rents all the time, so we're not stuck in a place. So that tends to give you a little bit of a hedge against recession. Mm-hmm. I found in my experience that there's anything that is recession proof, but typically in what we do with relatively short-term leases, you can reprice, which allows you to continue to raise your price and not bear the brunt of the other side of the ledger, which is when the expenses go up. In the real estate world, if you have an office building and you have a 10-year lease, you kind of stuck. Everything's going up and your rent stays the same. Same with retail. Industrial is a really hot asset class in now. They have longer term leases also, so people are starting to get a little worried about that maybe being a little bit bubble. So I'd probably brag on the space that we're in and say the most recession resistant. The other one you might say is also, which is sort of a derivative of it, but it's the single family rental space, which has become very popular now. I see a lot of people getting into that. That could be, a similar thing. And also you probably have two executions on that where depending on where interest rates are, you could also sell the house versus, repricing the rent.
That back office looks really different in a single family versus multifamily. How to manage it. Okay.
Yeah, it's interesting that it's become sort of a full-fledged asset class. I bought some single-family rentals back in the day, 20 years ago, and it was really hard to make money on a cash flow basis. You really just made the money when you sold the property. But we've seen Blackstone and Starwood, all these building out these huge platforms now. So I'm sure they're making money on it. They don't do it if they don't. So
they'll buy 100 homes at a time. I mean, they're just it's amazing.
Yeah, the economies are great.
Tell me about your process of due diligence and how do you simplify the process while still executing at a high level?
I talked about covering risk and the downside of it. The due diligence is super important. So we have what we've developed, a little bit of a template here. We have and as I have some young guys that work for me. We're big on. We always have interns from business schools, trying to mentor young guys. But we, so we put together a process which we think is pretty straightforward, but also pretty comprehensive. And we have a couple of pillars of it, which are, when we look at a property, again, I always talk about trying to protect the downside. We try not to skimp on thoroughness, but to try to do it quickly because, actually in our business, in this elevated deal environment, due diligence is sort of a negotiating point. You see that a lot in real estate deals. So somebody will say, okay, if you're not going to give me any more money, maybe you'll not do you'll shorten your due diligence. Because we would typically say, okay, we want to buy a property, we want 30 days of due diligence. They'll say, well, can you do it in 2 weeks? Can you do it in 3 weeks? Or the thing that we see a lot now is actually people say, can you, we would typically structure a deal where we would have, we put up a deposit, but the deposit is still refundable while we do our due diligence. And then once we do, we say, okay, you keep the deposit. A lot of people now are saying, okay, we want that money to be non-refundable at day one. And that's, so there goes the due diligence down the drain. So we do a couple of levels of it before we ever get too deep into anything. We make sure, and you'd be surprised how many people don't do this. We see the property. We actually go there. We have properties in 8 different markets around the country. Okay. But somebody has to be there and go there and see it and we have to look at the physical asset, and we have to look at the market and look at comparables and all of that. And then we do a very thorough underwriting of the numbers. We're pretty quantitative in terms of, we have a very detailed model, and we have certain comparable templates that we do. And this is all stuff that can be done, on a computer, in his desk, but it's very thorough. We can do it. And so we feel like we have a really good handle on it before we get too far down the road. So we sort of do it in stages. And then once we get to the point where, okay, something's live and we're really going to buy something and really put up a whole bunch of money, then we have to mobilize a team. And we, again, try to keep it simple. So the bedrock of that is really the physical asset due diligence, where we actually get a team to walk every apartment. So we walk every apartment, and we have an engineer go look at, the common part of the apartments. And that takes a couple of days, and they have to compile it. And then again, we just validate all the financial information that we had and the market. We have basically a checklist, and we go down, it's 2 pages. It covers everything. We want to make sure we know everything about the property, everything about the market, and any other issues such as, crime or new construction, things like that. There's ways to do it, relatively quickly, but there's really no substitute for actually doing the process. And again, I do see a lot of people, using it as a negotiating chip these days. And I assume that everybody, when you put real money out, people tend to do the right thing. But, I assume there are people that are probably not doing such due diligence these days. Yeah, I hope not. But
you bring up something very important. You're working with young people, meaning mentors and the graduates, and you're giving them opportunities in your fine organization. I just want to compliment you on that. That's really important.
We're very big on that. When we started, we had 3 guys who were, 40s, 50s years old.
Sure.
We needed some help. And, we hit on this idea of cheap labor, which was, we're here in the DC area.
Sure.
We went to Georgetown Business School and contact who was the guy that runs the real estate program there. And he was like, oh yeah, we're always looking for opportunities for our students. So we kind of hooked up with them, and we ended up having an intern. And, instead of having to hire somebody for, $100,000 a year, we get $20 an hour. A super smart guy. And so, maybe we didn't have the most altruistic start to it. And it turned out to be a great thing. And we have had an intern since then, have pretty much always had an intern. And then I have 2 guys that work for me who were my interns. And one of them's worked here 5 years, and one of them's worked here 3 years. And so we're very big on that. And my partner, Ken, actually now that's morphed into my partner, Ken, actually teaches one of the classes at Georgetown. And so we're very big on mentoring. And, even in my own personal life, I coached basketball for more than a decade, coaching kids from elementary school through high school. So that's a big part of what we do. And it's important. And, it even goes as far as this is a good example of what we actually, in the last, it was last month, it was in March, Ken and I actually, through a contact, ended up meeting these guys who are in the front office of the Miami Dolphins. And they do for their players in the off season, they do what they call their business combine. It's actually the same day as the NFL scouting combine. They do a business combine where they bring in experts on different businesses that the guys are interested in, explain the business to them, and try to give them some tips on how to not lose all their money and maybe career possibilities going forward. And so we did that. We took them to a property and we showed them, how a multifamily property works. And we've been, since then, they've been calling us with deals and saying, hey, I want to invest in this. What do you guys think of that? So we've been doing it with the NFL. It's kind of
very interesting.
It can be pretty rewarding.
That's a legacy. This is good for you and your partner. I'm proud of you guys.
Yeah, that's good. Makes you feel good.
Your company touts creating a sense of community for your residents as one of the things that make you stand out from other firms. What do you mean by that? And how do you create that sense of community?
Yeah, it's something, when we started our business and we tried to come up with, not just a business plan, but sort of a mission statement, if you will. I've seen it a lot in this business, especially when you get to the higher levels of the huge companies and stuff. We like to say that the properties we own are not just another number on a spreadsheet. We have spreadsheets with lists of all these properties. It's like, sometimes you have to actually take a step back and say, somebody actually lives there. Like, this is their home. This is not just like, and it's not just a box. Somebody actually lives there. And so it's important to understand that and treat that. I actually worked at a place once where they said, you're not allowed to call them tenants. You should call them residents. And you're not supposed to call it a property. Call it a community, and don't call it a unit. Call it an apartment. Because somebody actually lives in these places. And so for us, it was important to recognize that. And that goes in a couple of ways. One is making sure that we take care of the property in a way that people are proud to live there. So that's, I talked about getting a return on our investment, all that, but also, with common area investments of, improving the clubhouse or the pool or all of that, making sure that it's a place that somebody would be proud to live in, a place that we're proud to say that we own. And then the other part of that is actually trying to help the residents. And this is somewhat specific to individual properties because each of them have their own character. Some of the properties we own have, young, affluent people, and some have, more lower income tenants who maybe have, there's an income restriction or something like that. Mm-hmm. So we tried to develop some sort of programming to help to, provide some kind of service to the tenant and some. So as I talked about, my partner, Ken, he's actually on the board of Comcast. So we worked with Comcast to help provide what they call Internet Essentials, which is they have a program where they provide low cost or no cost high-speed internet for people that don't have the means to do it. So we tried to, on certain properties where that was relevant, we set up a big event and Comcast came out and told everybody about the program and set people up so they could get that. In another property, we teamed up with the local county and they used our clubhouse to provide health care classes for people. So it's very property specific. On a more high income property, the people aren't really looking for us to tell them how to do different things. And maybe on that, it's making sure that we have programming that promotes a sense of community. On one property where after COVID, when a lot of people are working from home, we're converting some of the common areas to co-working space so that people don't have to sit in their apartment by themselves all the time. So it has to be somewhat strategic and somewhat property specific, but it's in our DNA of trying to make sure that we recognize that this is something where somebody lives, this is somebody's home, and it's something we can all be proud of.
A common area, that was brilliant on you and your team.
Yeah.
Especially with COVID. Okay.
Yeah.
People were locked up in their apartments. Yeah, it's really tough.
Yeah. I mean, everybody's stuck in their little box. Everybody, want to get out and see some other people. So
very important
to do that. And obviously, doing that is also good business. You don't want people to move out. You want people to stay.
Sure.
Maybe you can charge a little more. It's not only the right thing to do, it's also good business. Right. So we think that, and, it's gone as far as, on the investment side and, taking it back to the investment side, this is a pretty big trend these days. And we've had properties that we've teamed up with people who wanted to make an impact. A lot of, say, family offices will say, younger generation, they're very focused on not just making a whole bunch of money, but they also want to do something that's going to provide, some sort of good to the world. And so we said, well, hey, look, we could buy affordable housing. And we closed a fund last year with Citibank as the primary limited partner, and they're focused solely on housing preservation. And so they want to make sure that we maintain apartments that are affordable to a wide swath of the community.
Okay.
So it's, it's the right thing to do. It's good business. And it's also becoming the way of the world now. And we're seeing even with very large institutional investors, they're very focused on these kinds of things.
See, that resonates really nicely, what you shared there. A lot of our listeners have children, and I'm suggesting to our listeners they could share with their children $1 million, $5 million, invest those assets with brilliant people like you and your partner, and they're co-investing. In other words, they're learning about the business. They're looking at ESG, things that you're already doing. Citibank did it with you.
Yeah. And
they feel they're engaged because a lot of times they don't listen to mom and dad, but they'll listen to a mentor like yourself, your partner's teaching at the university level. Right. This is the richness that's out there that's available.
Yeah. I mean, look, the investing business, the real estate business specifically, look, there are people in it who are in it for the wrong reasons, and they get a lot of bad publicity. And most people in it obviously are in it for the right reasons, but we really have an opportunity, I think. And we really believe that we have an opportunity in what we do, because in what we do in multifamily, which is, again, in its most pure sense, it's just an investment, and it's an investment in a brick and mortar property. But it really is it's somebody's home, and there really is an opportunity to do something here. And there really is an opportunity to do something right. And again, when you do it, it's not to the detriment of the business. So a new thing that a lot of people are doing, which we just signed up our properties to do, is, people that rent apartments a lot of times don't have either. They might have okay credit, but they're trying to build their credit to buy a house. Obviously, most people don't live in an apartment for their whole life. Want to buy a house, and there's a nonprofit that started up that provides basically the same level of credit reporting on your rental that you get on your mortgage, because you don't normally get that. The rentals don't report to credit agencies. And so this is a whole program now where they can do that. And so we just signed up our properties to do it. Some of the lenders, Freddie Mac specifically, is now incenting people who are borrowing money from them to do these kinds of things so they can build up that. So, there's lots of different angles to this.
Very good.
And it's where the world's going. And I think people who don't recognize it are, you're behind the times on that, because
that's a rich program. The idea that the credit worthiness of the family, they have a life post renting at that point, and you guys are part of helping them move forward. And again, that's a legacy side of it.
Yeah.
You're going to get a rent for X amount of years, but it's a family. And at that point, you created the tool set or willing to do the subscription to a platform that allows the creditness to be reported. Yeah, it's important. Yeah, I'm proud of you. Do you see any trends in real estate investing sphere? And is there any way to take advantage of them?
Well, in terms of the big trends from what we see in our space right now, you see, say that there's a big move to what they call the build to rent. So on the single family side of things, that's traditionally very mom and pop business and onesies and twosies. And now people are building these, basically subdivisions to rent out to people. That's kind of a new asset class. There's certainly money to be made there. Again, we talked before about where we sit, but I saw the headline today that mortgage interest rates just went over 5% for the first time since 2011. So it's going to be hard for people to buy houses right now. So maybe, I'm in the apartment business, so I don't know that I want everybody to go rent a house instead of an apartment, but that's a place where I think people, can look, because that's a new space in this market. When I look at the trends tend to sort of go in a circle, like in our business, like a couple of years ago, everything was urban, and nobody was doing anything suburban. And then COVID happened, and everybody's like, nobody wants anything urban because all the offices are closed down, so everybody wants suburban. But now, I heard the other day, somebody's like, we're back into urban now. So, I think that in the real estate space, which is really, where my expertise is, finding people that know what they're doing and people who understand the trends, but also understand how not to follow the herd 100%, to, follow the herd off a cliff, I guess. But finding smart people that know what they're doing and investing with them. If you're looking in the public markets, find yourself a REIT that has a good track record, knows what it's doing, or find people like us or other people who are investing and ask the right questions. Find people that you can trust that are in it for the right reasons, and go forward that way. You will make money over the long term. And if you invest in, time has shown over the long term. A lot of wealth has been created in real estate, and there's still a lot to be created, even in a sort of a questionable market right now.
Very good. Is there anything I haven't touched on that you would like to add or expand on? No,
it's been a great conversation. I really appreciate you having me on. I think, I'd love to, anybody that ever has any questions, both on the mentorship side and also on I like to say, we're about doing good, but we're also here to make money, and we're in business. I'm always happy to answer questions, to meet new people, love to see if there's business connections to be made. I tell people who ask me, what are you guys looking for all the time? I say, we're always looking for deals and investors. That's a constant thing for us. And so always love to meet new people and talk to folks, and also just, happy to be a resource for people, because, that stuff pays off in the long term. It pays back in the long term. So people can always find me on our website, which is RailField Realty. It's all one word.com. And you can email me. Just my email address is jsiegel, JSIEGEL @railfieldrealty.com.
Spell RailField for us.
Yeah, RailField is RailField, Rail and Field.
Excellent.
So,
thank you, John, for being here today and sharing your insights into investing and helping us all create a positive legacy for our investors. I want to thank our listeners. I look forward to being back with you shortly for another episode of the Private Equity Profits Podcast. The show has been produced by Market Domination, LLC.